Are you curious about how increasing interest rates can affect your finances? In this video, we'll break down exactly how rising interest rates impact your loans, savings, and investments. We'll also discuss practical steps you can take to protect yourself in a changing interest rate environment. So, without any further delay, let's get straight into it. With inflation on the rise, there's a lot of focus on interest rates. Among their many impacts on our economy, interest rates are one of the tools used by federal government to help combat inflation. Based on reports and announcements from the Federal Reserve, the Federal Reserve has already raised interest rates 9 times in a row. These increases follow over a decade of low interest rates and expansionary economic policies aimed at spurring growth. During this time of economic uncertainty, will inflation really begin to slow? Will labor shortages stabilize? Will housing prices come down? It's reasonable to wonder, how will higher interest rates affect me? Here's what you need to know about interest rates and how they could impact on your financial plan. So, what are interest rates? Put simply, interest rates are the cost of borrowing money. In a typical financial deal, there's a borrower and a lender. When lending money, there's always some probability or risk that the borrower won't actually repay it. To minimize the risk exposure and gain something from loaning their money, lenders charge interest. The amount of interest they charge is determined by the interest rate. Mortgage interest rates are a well-known example. Let's say you purchase a new home and take out a mortgage of $300,000. For this example, we'll assume the interest rate is 5%. With a balance of $300,000 on the mortgage, your monthly interest payment would be $1,250. It's almost a certainty that you are, or at some point, will be involved in a financial deal that involves interest. Depending on the situation, you may be the one paying the interest rate, or you may be the one earning interest, or you're lending your money to someone or financial institution. Now let's talk about that. How will higher interest rates impact you? Truthfully, there's no cookie-cutter answer for how an interest rate change will impact everyone. There are plenty of variables at play, including credit card worthiness, the amount and type of debt you owe. There are plenty of variables at play, including credit card worthiness, the amount and type of debt you owe, and whether or not you have current or future plans to take out a loan. Ultimately, rising rates will have the most direct impact on new borrowers and people with existing variable rate debt. In general, here's what you can expect. You will have to pay more total interest on new mortgages, auto loans, credit card debt, personal loans, and any existing debt with variable rates. This will also lead to higher monthly payments. Ultimately, you will have to pay more for anything that requires new financing or variable rates. As borrowing costs increase, corporations are likely to experience slower growth. They'll also be more hesitant to take out loans to invest in expansion. As a result, earnings and stock prices may grow more slowly, stagnate, or even decline. It's highly unlikely during periods of rate increases for the stock market to perform as strongly as it has in recent years. You will earn marginally more on your cash deposits as financial institutions raise annual percentage yields on savings, checking, certificate of deposits, and other deposit accounts. As fewer people borrow money to make purchases, demand for goods and services should go down. The intended result is for supply to catch up and the prices of goods and services to stabilize or decrease to curb inflation. If you're looking to buy a new home, you'll likely continue to find low housing supply. With higher rates, current homeowners who have locked in historically low interest rates are incentivized to hold on to, their current mortgages instead of selling. Depending on how interest rates become, you may decide to direct more money towards paying down debt more, which limits the amount of money you have to invest and save. Additionally, it might make sense to access cash or money from your portfolio to make purchases instead of financing. In either case, the end result is less disposable income. You have greater opportunities to redirect some of your cash holdings, like checking and savings accounts, to short-term duration investments, like treasury bills and Series I bonds, as these fixed income securities will likely offer a relatively higher rate of return than deposit accounts. Since these are government-based securities, the rates often adjust more quickly. In addition, the interest earnings potential on I bonds benefits from both a fixed rate and inflation rate. It's important to remember that higher interest rates are actually a sign of somewhat overly strong economy. Monetary policy is a delicate balance of push and pull with plenty of lagging indicators. While we're focused on rising interest rates right now because of high inflation, We've seen the Fed slash rates many times in recent years to stimulate growth and protect the economy, i.e. the 2008 recession and the early days of the COVID-19 pandemic. The Fed is rising rates now to combat inflation and put more, and I mean more, powerful tools in its tool belt to stimulate the economy when it's needed in the future. On a positive note, besides all this, there are some pros too. So let's have a look at some of the pros of higher interest rates. It can push prices down, lowering inflation. Higher rates make borrowing more expensive, which can reduce demand for goods and lead to lower prices. It also gives savers a chance to earn more. When interest rates rise, financial institutions typically increase the amount of interest paid on checking and savings accounts, money market funds, and other types of saving vehicles. Higher interest rates help investors earn returns with less risk. Investors who want to generate attractive returns with less risk may benefit from higher rates. Furthermore, it lifts certain sectors off the stock market. Investors may want to consider investing in market sectors that tend to do well as rates rise. These include communication services, healthcare, and utilities, which tend to outperform when volatility is high. The financial sector, which includes banks, brokerages, and other financial companies, also tend to benefit because lenders raise rates alongside the Fed. In contrast, real estate, consumer, discretionary, industrials, and material sectors tend to underperform when rates rise. Another question comes to mind whenever we talk about a rise in interest. What to do when interest rates rise? Rising interest rates present an opportunity to earn more on your savings. You can shop around for a higher yielding Vanguard money market fund and take advantage of higher rates and make your cash earn more interest. Increasing interest rates also bring an opportunity for higher yielding bond funds over time. In a rising interest rate environment, debt comes more expensive, so you might prioritize paying off high interest rate debt first. Current home buyers might see mortgage rates rise and take the opportunity to lock in a lower rate if interest rates continue to rise. Existing homeowners may want to consult with a loan advisor to reevaluate financing options based on current conditions. Check in and make sure you are diversified across not only stocks and bonds, but across economic sectors as well. In a volatile market, sector performance can also change quickly. It's as good a time as any to ensure your asset allocation reflects your risk tolerance and goals. At the end of the day, there's some understandable level of uncertainty. With interest rates on the rise, we're navigating an economy the likes of which we haven't seen in decades. As a result, you may need to reassess some financial decisions and approach new ones with a different mindset. When evaluating those decisions, it may be helpful to work with an experienced financial planning team. These are the types of decisions and complex situations we help our clients prepare for and navigate every day. So that was it for today, guys. We hope you liked the video. Before going, make sure to like, subscribe, and press that bell icon so you never miss another video. Till then, goodbye.